Investors may have learned by now that there's not always such thing as quiet in the summer markets. Our chief equity strategist and economist John Blank is here now to discuss what this summer is bringing to us. A few weeks ago, John, there was a global market meltdown. That and other geopolitical concerns brought heavy volatility to our stock market for a day or so, and then some encouraging economic data came out to calm things down a bit. Is that calm going to be with the market for a while?
I think so, Terry. We had a VIX of 16. We had a VIX of about 13 before the big spike of a couple of weeks ago. So another 3 basis points to work down over the next few months, and that's generally what happens. So that will calm the market.
Global markets have had a bit of a torrid time lately as well. What's behind that, and has calm returned globally?
Yeah, calm has, well, I wouldn't say returned, but I would tell you that, we're getting to a place where the overall tone out there is such that past the Fed decision making, markets are going to hold their poise a little better. So I think it's mainly getting the Fed rate cutting behind us that will calm the markets in international.
Investors had been fretting that U.S. and global stocks might be looking too pricey. What's fair value currently for the S&P 500?
Well, fair value is 49.30 or to 49.50, so just under 5,000. We are at 5,600, which is 650, basically 10 to 15% above where the fair value is. And as I remind people who read my market strategy report, I have always considered 10 to 15% additional on top of fair value over the last 6 or 8 years to be considered appropriate, because the quantitative easing, the sheer trillions of money printing that the Fed has done are sloshing around out there and putting that extra 10 to 15% of the market. People say, we're getting a bubble, but I think really the answer, looking at it year on year over the years is, you get this 10 for 15% overvaluation that's kind of consistent and kind of hangs in there.
And what I've noticed, and correct me if I'm wrong, even a reasonably solid Q2 2024 U.S. earnings season hasn't really been able to soothe market jitters totally. Does that concern you?
No, I think we should expect that, because the Federal Reserve has got a cooling labor market, and the sheer number of perma bears out there are always looking at the cooling labor market and determining that we're about to tip into a recession. And until time's passage, multiple months, we won't find out who's right or wrong about this, but the noise will be sufficient to keep enough of the bearishness into the market.
Well, speaking of the Fed, around half of the world's developed market central banks have already started cutting interest rates. Bank of England did so on August the 1st. Federal Reserve is teeing up for a cut in September. So now we have the Jackson Hole Symposium thrown into the mix. And the big question seems to be more of just how much of a rate cut can we expect, and not necessarily will there be one. Is there a number priced in?
Yeah, I think right now it's 25 basis points is about 2/3 assessment, and there's about a 1/3 chance for 50 basis points. And I generally think that's pretty much consistent. For those who are interested in the Friday discussion from Federal Reserve Chair Powell, the Economic Policy Symposium, topic is reassessing the effectiveness and transmission of monetary policy. So he will basically take that title and have formed a discussion topic around it, along with the rest of the meeting. So what that is driving at is he's going to discuss, how these rate cuts are going to play out for the labor market and for the inflation rate. So in time, that is what you should expect out of him on Friday.
Yeah, and so we're talking here on Thursday, August 22nd. As you said, tomorrow, the 23rd of August, is the day he gives his speech. And so what you just described, is that the tone of his policy message that you expect to see come out?
Absolutely. And Terry, I've said this before on other segments of videos that I've done, and don't expect him at all to tell you whether he's going to 25 or 50. He will not tell you that, because he does not want to impose a decision on the Federal Market Open Committee Open Market Committee in September, and he wants to see the data himself before that meeting. So there is absolutely no way he's going to tell you what he's going to do in September.
So there's also an upcoming jobs report for August that's due out on September the 6th. Now, given what the last jobs report sparked in the market, and now just yesterday, the Labor Department's downward revision of jobs data, is all of this now a new wild card?
Not really. I mean, Goldman Sachs says that, really there'll be yet another revision to the revisions, which is typical for jobs. They have two sets of revisions. And the backward-looking revisions, by the way, are 9 months of 2023 and only 3 months of 2024. It's 2 through March of 2024. So the revisions are really on 2023, and and I know that markets are forward-looking, not backward-looking. So telling the market that, we bid 225 to 250, which is what Goldman says. The numbers indicate 175 last year. That's still above, what we needed it to be, which recessionary would be no lower than, but lower than 150. So we weren't in recession last year. And what it says is that productivity gains were probably higher because growth, that didn't change the GDP growth rate. So if you have less employment, you have higher labor productivity. And basically, we kind of are understanding things only through March. A lot of the bearishness here is like, this is like all of 2024. I'll tell you, first of all, they always do this yearly revision to kind of true things up, number one. And number two, this is actually more about 2023 than it is about 2024.
All right. You wrote recently that what happens to the S&P 500 returns in the second half of 2024 and 2025 can look just like average annual stock market bull runs in years past. So is there much market optimism at this point?
Oh, absolutely, Terry. I mean, we're sitting on year-to-date gains of 17 to 18% for the S&P 500 and almost 19% for the NASDAQ, which is tech-driven. So yeah, I mean, the Mag 7 are back in fashion, and growth in terms of earnings and revenue growth rates in the third quarter, assessment coming out of the second quarter earnings season is pretty good. So no reason to not expect the bulls to carry the weight of this market for the rest of this year too.
All right, looking at a few strong buy stocks now, namely Paramount Global, Tenet Healthcare, and C.H. Robinson Worldwide.
Yeah, let's talk Paramount Global. Ticker PARA is the non-voting shares, and then PARAA is the voting shares. The voting shares obviously are trending up. The non-voting shares are not going anywhere from 10. Why is that? Because there's a big merger or buyout from a number of players. One actually this week, the Bronfman Group on Monday, but they also had Skydance before that. So, and then behind them is, of course, do Apple, Amazon, and Netflix and groups like this start to look in on Paramount. So, first of all, keep in mind this is two different shares of stocks, one non-voting and the other voting. And the other thing is, in front of that acquisition that's likely to happen, and they've already taken out a lot of the labor force, 10 or 15%, and that has driven up estimate revisions. So the stock from a fundamental perspective here is actually worth looking at it, and from a merger acquisition perspective is also a play here.
Tenet Healthcare.
Tenet Healthcare, ticker THC, number one rank with an A for value and a B for growth, Terry. Even now it's at 160 with a target price of 170. If you bought this in October last year, you paid $60 a share or even lower. So you doubled your money in a year. What you learn here is there's been a lot of hospital procedures that even surprised Tenet in their hospital network. And I don't understand, Terry, I have looked into it. I don't understand the entirety of why people are going more to the hospital in the last year versus what people expected. But it certainly happened, and it's bullish, the stock.
And C.H. Robinson Worldwide.
Yeah, ticker CHRW. What you're going to learn here about, it's an old Minneapolis-based transportation group. And during the COVID pandemic, as you remember, we had these big backups at the ports, and that caused a lot of the trucking and transportation groups to widen their pipelines to get more stuff out of the ports and into the rest of the country. And that after that pipeline was, opened and the shortages were taken down, there was a collapse in transportation prices across the country. And In their latest earnings, which just came out a couple of weeks ago, they actually had pricing strength, and it looks like they're putting behind them this big bottleneck issue. However, I have also read this morning that C.H. Robinson has talked about all these labor strikes from India to China to Canada to all these places, and that they're now worried about labor strikes driving up shipping prices. So keep an eye on shipping and transportation right now. It's in a hot area.
Our chief equity strategist and economist, John Blank, on the summer markets and the Fed. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.